Hello, everybody. My name's Carl Fisher. I'm one of the co-founders of CamaPlan, and we're happy to have Michelle Goheen with us today. Matt Moore is going to lead the presentation and handle most of the questions. I just wanted to stop by and let everybody know I'm still alive and kicking, and we've got great people here to talk about UBIT. We always get questions about it. And we've got what I would say is one of the experts in the country here that will actually help limited partnerships or general partnerships or corporations, whatever asset providers are out there, to handle the UBIT, not be afraid of it, and use it for IRA investments so that they can talk to the clients and not leave anybody hanging. So at this point, Matt, if you can take it over and give the people the real details, that would be great.
Yeah, you bet. Thanks a lot, Carl.
And
Um,
welcome to Michelle too.
awesome.
Thank you. Glad to be here.
So as Carl mentioned, my name is Matt Moore. I'm a business development manager here at CamaPlan. So I know we're all anxious to talk about UBIT and learn from Michelle, but I wanted to quickly just do a quick presentation about how CamaPlan is working with capital raisers to help you access more IRA money. So in the audience today, we have a mixture of investors and capital raisers. So I just wanted to kind of run through this. I promise I won't be too long because we all want to get to the UBIT, but thanks for sitting tight with me as I go through these slides. So if you are raising capital, especially if you're on the webinar today, you probably really appreciate what kind of potential there is in the IRA space in terms of fundraising. But so that we all are on the same page, as of 2024, it's 38 trillion in both IRA and 401k assets in across the country. And even more interesting is the trend towards folks who are wanting to take more control over their investing. So 33% of investors manage their portfolio without an advisor, and then assets in self-directed brokerage accounts is up to 25%. So it's a lot more people who are wanting to have a bigger role in how they invest. But despite that, only $400 billion of assets are in self-directed IRAs out of the whole IRA pool. So we think that CamaPlan, we see this being for really two reasons. Either people just don't know about self-direction, or they've been told by their advisor that they shouldn't do it, or their advisor doesn't know about it, so hasn't brought it up to us. And so we want to aim to position ourselves as a resource for your capital raising efforts to be able to show your investors how they can participate in your deals. And one of the ways that we achieve this is being able to look at a comparison of a deal in a self-directed IRA, or like a Roth IRA specifically, versus non-qualified funds. And this is an example of something that we see really often. This is a investment into an apartment building, 7% preferred return, a lockup of 5 years, and a projected equity multiple of 2x. And when we go to the next slide, I won't go through each of the rows, but I really want to highlight the headline here, which is that you're going to save almost 30 grand when you do this deal as an LP in a Roth IRA. And so providing these numbers for your deals to your investors is a way that we want to support your fundraising efforts. And our process to help you fundraise is pretty simple. First, we just do an intro call. We identify a funding opportunity for you and determine the best way to get started really and what your timeline is. We come up with a marketing plan. We do webinars. We do email marketing, social media posts, all centered around your deal and the opportunity to participate in your deal through self-direction. And then finally is the actual account opening step. And this is where we're working with your investors to answer their questions, get them comfortable, and get their account open and funded. A little bit about us. Carl, like he mentioned, is one of the co-owners of CamaPlan. He opened CamaPlan with his sister Maggie Polisano in 2004, so we're about to turn 21 in August. We have 8,000 accounts across the country, all 50 states, DC and Puerto Rico, and just over $1.3 billion of assets under management. Of that, of that capital, we've helped $500 million has been done alongside sponsors who we've helped to raise that money from IRA accounts. And that's been across a variety of assets, whether it's real estate, debt, mineral rights, you name it, we've probably done it. And we've helped a lot of capital raisers unlock more IRA money. One of the ways that we've been able to achieve this is just through a commitment to great customer service. Our clients are on hold for less than 2 minutes. 96% of calls are answered the first time by a real person. And when it comes to getting the money into the investment, we have a 48-hour turn time once the account is funded to getting it over to the investment sponsor's deal. So if this is something that you want to talk to more about and talk more about how we can get started, please email me or give me a call at that information there. I'll definitely put it in the chat so you all have it. And I'd love to talk to you and come up with a strategy about how we can help you fundraise from IRA accounts. So without further ado, thanks very much for letting me get that out. Michelle, I'm going to turn it over to you.
Excellent. Thank you. And I am going to share my screen real quick. Okay. Can everyone see that okay?
Yep.
Okay, great. I don't have my notes or anything. I'm just kidding. So anyway, it's great to be here with y'all. My name is Michelle Goheen, and I am a CPA. Been a CPA for a while, 30 years, so don't do the math on that. I've also been a real estate investor for pretty much all of my career in one form or fashion. I spent over a decade with the Big Four, with PwC and Ernst & Young. So I have a lot of very big transaction experience. I really focus on mergers and acquisitions and helping companies raise billions and billions of dollars. So I got into real estate several years ago, or into syndications, when my daughter came to Ole Miss, and that's where I am this week. I've done 4 projects now as a sponsor and a general partner. So for you who are on this call, who are sponsors, I'm kind of right there along with you and can help you kind of walk through the best ways to do things. And also as an investor through IRAs, we can talk about that as well. So I also co-founded the Real Estate Tax Strategy Institute with some of my favorite tax strategists. Because I really noticed that there's so many people out there who, it's very complicated, but there are some things that are very basic that I really love educating people about and really helping investors keep more of their hard-earned money. And when you understand the strategies, it's not that difficult to execute. So with that, we're going to go in and talk about UBIT. A lot of you guys have probably heard, don't invest in your self-directed IRA because you have UBIT. It's so complicated. I don't want to deal with it. What UBIT's going to wipe out all my returns. Carl and Matt, you probably heard all sorts of different things about UBIT. And so what we're going to talk about today is what does actually trigger UBIT when you are investing in your self-directed IRA, and how depreciation and different types of losses can actually eliminate most or not of all the UBIT. So for example, in Matt's example he showed you earlier where there was about $10,000 of UBIT tax, I can restructure that for him and basically take all of that away. So Matt, I'm going to help you work on your example after this call. So we're also going to talk about how you can use smart leverage to boost your overall returns. And even if you have a little bit of UBIT at the end of the day, I'm going to show you why that really does not matter. And then we can also talk about if you want to structure deals to reduce or eliminate UBIT entirely, we're going to do that as well. So with that, who knows what UBIT is? So here's the definition. It's unrelated business income tax. The definition is a little complicated and it's a little vague. It basically says that there's a tax that's earned on income that's earned by tax-exempt accounts, such as IRAs, from activities that are unrelated to their tax-exempt purpose. What does that mean? What you're going to see is that in a self-directed IRA, where this comes about is when you use leverage in your IRA. What that means is if you were just investing in index funds, you would have a $300, it makes my math easy, a $300 investment, and you would buy $300 worth of index funds. So when you're investing in a self-directed IRA in real estate, you would take that same $300, but you would actually control $1,000 worth of real estate using leverage. So that $700 of profit or additional money that you're going to be earning profit on is considered the UDFI, the unrelated debt financed income. And then the related tax on that is UBIT. It's a little complicated, but we'll go into a little bit further. So just know that when you are getting taxed UBIT, it's solely the profit that you are making on borrowed money or other people's money. I'm going to move our pictures out of here so it doesn't take my so essentially the IRS is taxing you on the money that you're making in your IRA with other people's money. So it's really not as unfair as it may sound initially. So we'll go into that just a little bit further. What I want you to know, you don't have to be scared of UBIT. There are a lot of examples in real estate syndications, like the ones that I do, where there is no UBIT at all. Depreciation, especially bonus depreciation or through cost segregation, is going to be your best friend. As a sponsor, it's going to wipe out all or most of your UBIT exposure, just depending on your debt load. And I have some examples we can go through as well. And then again, when the UBIT does apply, it's only on the profit that's tied to the borrowed money. So while you to grow your returns inside your IRA, tax deferred or tax free if you're in a Roth, you're using your leverage to increase your buying power. So that part's really cool, I think. And so we're going to talk about these strategies to avoid or reduce UBIT, even in real estate, leveraged real estate. And so there are some things as a sponsor that you have to make sure that you do to make sure that your investors do take advantage of this, because there are a few things that if you don't do, it will kind of screw it up for them. So,
And Michelle, can I just
yes,
interrupt you for 1 minute?
absolutely.
If anybody has any questions, if you can use the Q&A function on this, that would be great. That way we'll get them to Michelle so she can see them.
Absolutely. So what I'm going to show you here is a real world example. This is actually one of my examples. So say there's a real estate syndication and I have someone invest $100,000 through their self-directed IRA. So what they've done is that they've either had an abandoned 401k from like 3 jobs ago that they were like, hey, I forgot about this. Let's move this over to CamaPlan and invest in a self-directed IRA. They can do that and then invest as a limited partner in the syndication. So this is what this person has done in this example. So 70% of my real estate is going to have debt on it. So, and we're going to show cash flows of what I'm showing here. At the end of the day, and of course, there's all the asterisks about, this is all projections and things like that. But what you'll see is that most of these syndications are going to be like 1.8 times equity multiples to 2 equity multiples, meaning that if you put in $100,000 at the end of the exit period, usually about 5 years, you're going to get your money back and you're going to get another $100,000. Pretty cool. So what we're going to show you though is how the UBIT tax would be calculated or applies to this situation. So, excuse me. Okay, so as we know, the taxable part of UBIT comes with the debt. So what we're going to say is 70% of this cash flow that we've earned, because after the 5 years, we've earned $100,000. So only $70,000 of that is actually subject. It's called the UDFI, which is what UBIT is calculated on. But what's really cool in my syndications, and hopefully the ones that you are talking to, if they are real estate, multifamily, um, any types of storage, any things that have assets that can be segregated into shorter term lives. And especially if bonus depreciation comes back to 100%, this is going to be especially cool. What you would be able to do is go through and do cost segregation. And I can give you, if you don't know what cost segregation is, I'll give you some links at the end so you can learn about it. It's one of my very favorite topics. So what we're going to do is we're going to generate a big loss in your 401k because of depreciation. We're going to take a bunch of it the first year. And then years 2 through 5, we're going to do some other tax planning where we're going to be able to deduct some interest. At the end of the day, we have shown on paper that you've lost $86,000. But we know from a cash flow perspective, you've really gotten $100,000 worth of cash over that 5-year period. So why UBIT's not going to apply in this portion is that even with that large exit that you're going to have at year 5 and $70,000 of that 100,000 that you made is related to your borrowed money, essentially. That amount, that gain is still less than the $86,000 of accumulated losses that you've had that are primarily related to depreciation and interest. So once that your UDFI is less than your accumulated losses, there's not going to be any UBIT that's triggered. So your IRA is going to grow tax deferred, tax free in this type of situation. So pretty cool. Now, there are some things that in a very similar thing, if you have higher leverage, if you perhaps have a situation where you're going to make a higher return, where the actual equity multiple is going to be a little bit more, you may get into a situation where you do have a little bit of income after all of the deductions. So in this example, we have a little bit more leverage and we have a little bit higher equity multiple. What this is going to show you that even though we do have a taxable gain that's going to be taxed, we're going to have a UBIT tax associated with it. At the end of the day, still growing tax deferred in your self-directed IRA, your net return is still going to be over 2. Whereas if you were an ordinary investor and just being taxed on your ordinary income and your capital gains, this would be your equity multiple. So I guess what this is showing you is even if you have a UBIT situation, it makes sense to analyze it within your self-directed IRA and without your self-directed IRA, because you may be surprised. And with the self-directed IRA, your after-tax returns most likely could be higher. So that's something that I can help you with, help you analyze. So we'll talk about that at the end as well. So what may trigger UBIT? Because what we've talked about so far are real estate syndications that are very heavy in the real estate and have depreciable assets. So there are some investments that you may be interested in putting into your self-directed IRA that you just need to make sure you realize could trigger UBIT. For example, raw land. There's not going to be any depreciation. There's really no operating expenses. And so any gain that you have would be taxable under UDFI. Now, ground up developments may be very similar since there's little or no depreciation in the early years. If you don't do cost segregation, you're depreciating it over 39 years. It's going to take a while. So if you are a sponsor that's not doing cost segregation, get with me, I'll hook you up, because it literally one of the best strategies that you can use. If you are a flipper or a house flipper, that's generally considered an active trade or business by the IRS. And so UBIT will apply for that. So if you're going to do flipping, maybe you do that outside of your IRA, but then you do some other things that are more passive within your IRA. So that's one of the things I like to do, is really help people look at their global strategy. And you have your pool of money within your IRA, and you have a pool of money without your IRA, and make the most sense of, let's invest here with my IRA money, and here with my my money that's in my brokerage account that I have not been able to get into my IRA yet. So crowdfunding platforms a lot of times aren't going to push through depreciation. If you have an active business, again, these are going to trigger you, but just by default of what they are. They're operating businesses within your IRA. And then a lot of the times bridge loans and things like that can trigger it as well. So what is what's important to look for when you are talking to investment sponsors, or if you're looking at deals? How can you spot, I kind of call it a UBIT friendly deal? For people like me who are general partners or real estate syndication sponsors, you're going to ask us, hey, am I going to receive a K-1 at the end of the year, the beginning of the following year, that shows my allocation of losses? If your sponsor doesn't know what a K-1 is, you know, uh, they either need to get educated or maybe you need to talk to someone else, because it's super important that you get this document that shows your loss that is generated. While you're getting your cash flow, again, you're gonna have your paper loss for tax purposes. Totally legal. It's just accounting, tax accounting. There's, it's all totally by the book. And especially if you've done that cost segregation, you're going to have a very large loss on this K-1. So again, don't be shocked when you get the K-1 and it has, a big minus number on it, because you know that you've actually been receiving your distributions in your account. So you're making cash flow, but you have a tax loss. So if that is not going to be the situation on these types of investments, if you are self-employed, you may really want to consider getting your money into a solo 401k. And Matt and Carl can help you work how to do that, because solo 401ks are exempt from UBIT on leveraged real estate, which is really cool. And if you have it structured correctly, your company, you can contribute to your solo 401k, and the company that you own can contribute as the employer to your solo 401k. And I think if you're over 50, I think it's close to $75,000 that you can take from your profits and invest into these accounts. So it's like tax savings on tax savings, which I really like. Or if you are a sponsor and you have some of these activities, for example, land or development, there is a way that you can structure a class of your investors that is what they call a debt-free class, or a class B. That's going to be units that are designated for the self-directed IRA investors only. And what you're going to do with that is you are not going to allocate any of the debt to them. It's not too complicated. It's something that we can either do another webinar on and get really into the details on how to do that, or you guys can contact me. I'm glad to kind of walk you through what that would look like. There are some other structures, like we were just talking about the Class B, that we can do to reduce or eliminate UBIT as well. So, like we just talked about, if you have a solo 401k, there's a lot of things that you can invest in that are different from a self-directed IRA. Again, the real estate syndications that have leverage, you will not be charged UBIT. Rental properties with mortgages, raw lands those are also good things. And you can kind of read on with those. So just know that if you're self-employed, that there are options that you have outside of just what a self-directed IRA would have. And if you are also worried about the UBIT tax in your solo 401k, make sure that you aren't involved in flipping businesses, because again, this is considered an active trade or business that is going to trigger the UBIT. And a lot of private equity or venture capital funds that invest in active businesses, those are going to generate UBIT. So just kind of be aware, and as you're investing, understand within each of these solo 401ks, self-directed IRAs, which ones are really the best for each type of investments. So quick rule of thumb is, if you have income from rent or appreciation on real estate, if you're self-employed, the solo 401k is the way to go. But if you are working, like I was saying, the active business, the UBIT most likely will apply. So I know it's a lot, So,
Michelle,
yes,
do you want us to feed you the questions at the time, or you want to wait to the end?
either way, if we have applicable questions, glad to answer them.
All right, here's one of them. How does UBIT apply from an LP's perspective if an LP in a private real estate fund, say 7-year life, but each asset held or sold at 5 years?
Okay, so the question is, if you are an LP and you if you've been receiving a K-1, um, and that shows a loss, there's a form that the tax preparer will prepare each year that shows your loss, and you can carry forward that loss each year. So, for example, what I was saying before, say you had a $30,000 loss and a $45,000 loss, and then all of that is going to accumulate until the end. And you would take at the end of year 5, you would take your $80,000 loss compared to the portion of your investment that was leveraged and determine if a UBIT was due or not. It's actually, I think, calculated on a year by year basis, but if you do have a big depreciation in the first year, then it won't matter. So, in your example, though, if you've not received a K-1, though, um, that does put you in exposure because you don't have the loss that you can show. So I would get in touch with your sponsor and ask where your K-1 is, because as a joint venture or as a LLC, as a limited partner, you should be receiving your K-1 every year. And that will show your loss. Generally, some of like the accounting firm that I use, they will prepare these tax forms for my investors. So, as a sponsor, you can ask your accounting firms as well and make sure that they are doing the things that will help your sponsors, or I'm sorry, help your investors be compliant with what they need to file with their returns. Does that answer your question?
I think so. I mean, somebody else popped it in. They'll type another one in.
Okay.
Um,
I'll give you my email at the end. So if you wrote the question, if you have any more questions, just email me and I'm glad to dig into it further with you.
and then there was another question. Some people say just keep track of the losses until the end and then do just one form, at the sale. And other people say do your 990T every year. The people we've talked to said do them every year because, one, it starts the clock rolling on how far back they can look at it, and two, it uh, uh, sets it up and has it on record in case something happens to the IRA owner, et cetera.
Absolutely. And that's exactly how I would recommend it. When I mentioned my tax people do the tax forms, that's exactly what it is. It's the 990T that is done on an annual basis that will show, Michelle invested $100,000 or in her self-directed IRA. Michelle's self-directed IRA investment has lost $40,000 due to depreciation. So they would have that rolling as a loss until the end.
Thank you very much.
Sure, absolutely. Absolutely. Great questions. So, I'll just kind of go in and as a sponsor, there are things that you can do depending on the type of syndication that you have that you can offer these UBIT friendly type of options. Like I mentioned, you can do a debt-free investor unit that's going to set up a separate class of investors that are not exposed to any leverage. You can, again, kind of raise an unleveraged tranche, which is it's kind of similar, but a little bit different the way that it's structured. And then also be able to go in early as you're talking with these investors and provide these UBIT exposure projections, kind of similar to the example that I ran for you earlier. Here's your $100,000 investment. We're doing 70% leverage. This is what we're estimating as our K-1 losses based on our cost segregation, our interest, all of these, and kind of map it all out. It's very easy to model what your projected UDFI or UBIT would be in a syndication like this. And then, Carl, I'm going to kick it back over to you to talk a little bit about some of these UBIT blocker entities that can also be done.
Sure. Thanks, Michelle. I love what you're talking about here. It's great. C corporations, a lot of people use the C Corp. I personally just want to say that anything that has UBIT and is paying taxes, I like it to be in a Roth versus a traditional. And sometimes I'll even take the traditional and convert it to a Roth along the ways there. But if you get a C Corp, you end up paying C Corp taxes, which are 20 or 21%, I think today. So you don't get away with complete. And then when you figure out sometimes the UBIT, you directly, you would even be paying less for it. So I think there's a lot of asset providers that are familiar with these going forth, and some do use them. And once the money goes into your IRA, especially if it's not a Roth, then you're going to pay taxes on it again when it comes out. So that's why I promote using the Roth. The offshore blockers with the, and the Caymans and some of the other ones and offshore C Corps, I'm not as excited about, and I don't think they're worth the time and the money unless you're into a very big deal. I would say hundreds of millions investments to make that worth the time. And then there's another slide that goes into it, that debt funds, which I see and I like the best. And you kind of talked to them, I think, in the last slide with the leveraging there. But equity funds and asset providers will make two funds. One, because some people want equity in the deal, especially younger people that aren't using their IRAs, and wealthier people that don't have to use their IRAs, but at some point they turn 73 and have to take RMDs anyway. So if you have a debt fund, you basically can capitalize more on IRA owners because they either want the equity or they want the monthly payments or quarterly payments or annual payments to their IRAs to make these, and they'll give up equity and they'll give up some return. So a lot of the asset providers, fundraisers like that. But all you do is create another fund, and that fund is lending money to the equity fund at a certain rate, and then that goes back to the individual IRA owners, and that's what we're seeing a lot more happening with in the outside world and different equity funds, especially since the interest rates went skyrocketing, a few years ago. So people are making these debt funds and trying to take over from the banks. And
I
get
really like that. And I like, Carl, what you mentioned the other day about with these debt funds, as people are turning 59 and a half and can take their distributions, that these can provide a nice income source for them in their retirement as well.
Yeah, sure. They don't want to wait 5 years for the big exit, and getting 2 or 3%. If they can get 8 or 10, they'd be, pretty happy with it.
And they can go to the Caymans with what they say.
And then they can go to the Caymans and
There
get
you go.
yeah.
Maybe that's how we'll have to put the Caymans in the next slide.
Yeah,
So
you just want, if you're talking to all these people, you want to have a product that they want. So either they want equity or they want to, the majority of them want equity or they want a interest payment.
yeah, I really like that. And then so you have your debt fund and you would have your self-directed IRA investors in the debt fund, and you're literally investing that into your syndication, is what you're saying, as
The asset provider takes that and puts it into the syndication and pays them monthly with the money that's coming off of it.
just absolutely brilliant. So so essentially, as a sponsor, you're still able to raise your money. You're just raising it either as debt, which everyone knows is less expensive than equity, or if people do want equity, you can do that as well. So Absolutely love that. So, um,
Eloquently said, Michelle. Thank you.
oh, thank you. Thank you. So at the end of the day, I mean, I could talk about this all day long. I'm like just a total tax nerd when it comes to trying to save money and finding ways that really make sense for people. But do know that if you have a deal that is structured well, you are going to be able to give better returns to your investors and be able to really help them identify how the best way it is to invest with you. So, for example, if you, like I said, if you're talking to an investor who has some money to self-direct in their IRA, or they have some cash sitting on the sidelines that they'd like to get more than their like 3% from Chase, there are different things that make more sense. Um, I would never, since I do a lot of tax strategy, I would never have someone buy a vacation rental that they're going to do as a short-term rental in their self-directed IRA because of the tax benefits that they could do using their own cash for that far outweigh any of the benefits they're going to get over here. So knowing what assets make the most sense with the cash you have available make a lot of sense. So then take your money, put it into syndications where it's passive and just get cash in it that way. So I guess what I'm saying is, as a sponsor, it's so important to learn these different types of opportunities and really help your investors be able to strategically invest their cash. So, end of the day, I want people to know that even in some of these deals that do have a little bit of UBIT, consider the trade-offs. In your self-directed IRA, you are growing tax deferred or tax free in that Roth like Carl likes inside your IRA. That's really cool. There's no capital gains at exit. You're gonna have a lot of less volatility than the public markets. You won't be looking at your account every day and seeing it go up and down and getting stressed out. And there's just also with real estate, there's strong cash flow and long-term appreciation potential. A lot of these syndications are being structured where they're, like I said, making a 2x equity multiple in 5 years. That's essentially a 20% return a year. Again, it's because they are leveraging part of the transaction and increasing your purchasing power with debt and other people's money. But by the way that they structure that, and again, even if there is a little bit of UBIT, like we showed in that one example, it's still much better off than paying capital gains and ordinary income. So make sure that you understand just kind of going in what you're looking at, so there's no surprises, and just don't be scared of UBIT, because I know at least probably 50% of the people that I mentioned self-directed IRAs to, they're like, ooh, I don't want to do that because of UBIT. And after we kind of walk through it, then they go, oh, okay. It's just kind of one of those urban myths.
And a lot of their accountants don't understand it and scare them away from it, we find.
Absolutely. And I will tell you, a lot of the times when I do talk to people, they end up getting kind of upset with their CPA that they haven't learned these types of things. And I don't want that to happen, but a lot of times people who are, or CPAs, we can specialize in 100 different things or 1,000 different things. And most Main Street CPAs that are helping small businesses really aren't focused on, maximizing your tax efficiency for your real estate investments. They are taking the information that you've given them to prepare your tax return and preparing your tax return. So if people need real estate tax strategy, you need to go talk to a real estate tax strategy person, figure out what you need to do to implement that, and then either have your CPA educated as to how to report that, or just work with a CPA that is knowledgeable in real estate taxes. So a lot of capital sitting on the sidelines right now, like we talked about. Matt's numbers were astonishing to me. There's a couple of things that I can help you with as a sponsor. I know I sit in a lot of these webinars and I get a lot of great information. And at the end of the day, I'm like, okay, well, what can I do with that information? Go run with it. But if you still have questions, as a CPA, I help sponsors I can help review your deal structure. I can help you do that analysis that shows, okay, here's what a pro forma UBIT exposure would be. I can help you put together the Class B or the debt-free options that we talked about and help investor-facing languages. We can take a look and say, what what will make this offering more
I think Michelle is frozen. Is she frozen for you, Carl?
Yes, we might be running into some technical difficulties. Matt, if you happen to have Michelle's phone number, it might be worth sending her a text and just asking her to possibly leave and re-enter
All right.
the
1 second.
webinar.
Sure.
I'm going to use this time just to get through our disclosure. CamaPlan does not endorse any investment or any company. We do not provide any legal, business, or tax advice. Please consult with your professionals. We do not sell any investments. This presentation is for educational purposes only. We encourage you to include your professionals in the due diligence before purchasing any asset. And if you need our help, we'll be glad to be on conference calls with any of your professionals. Did you hear that, Matt? All right, I can't hear you for some reason.
Matt is muted. I'm not sure if he's actually talking, but we could hear
you,
Carl.
Yep.
Thanks, Mike.
Have you heard anything from Michelle?
Not yet.
Okay.
Give her a few more minutes. Let me see if there's any other Q&As out there that. Somebody asked, what's the difference between UBTI versus UBIT? The acronym stands for Unrelated Business Taxable Income, is UBTI. And then UBIT is the tax you would pay on that taxable income. Unrelated Business Income Tax, and that's the actual amount that you would pay. So the first thing you do is figure out what your taxable income is, and then from that, based on the tables that the IRS puts out, you would calculate your income tax for that income. Some people, it's a good question because some people confuse those. I wonder if all our internet went out.
By the suddenness with which she was gone, that is what it seemed like to me. There are 3 questions sitting in the Q&A. Feel free to say, maybe Michelle is better to answer it, but I'll read them out to you guys. Leo asked, some preparers say to prepare a 990T every year, even when there are losses in the first few years.
We answered that one.
Oh, okay. Gotcha. It was still on there, so I wanted to make sure that it got answered. And then James Waters asked, so to be clear, this webinar was addressed to sponsors and IRA investors, correct?
Yeah, absolutely. We set out to kind of tackle UBIT in full, and we know that we talk a lot to our clients about UBIT, but I also talk to a lot of investment sponsors about how to actually communicate and understand it from the sponsor side themselves. So we figured, why not just try to incorporate the lessons into both into one webinar, because the information is valuable for each party.
And the other side of that is when you get that K1, it should say that it is a an IRA or a 401k in one of the boxes there on the first page. So always look at that, and a lot of the asset providers aren't even aware of that. They try to put all of the onus on the IRA owner, but they do have a requirement to report what is IRA and what is 401k on the K1 so that the preparers know that.
Michelle, you've returned.
I've returned. I heard I froze up. What happened?
We're not sure, but
Okay, I'm back.
we're all good. We understand that margarita is not going to make itself, right? So
That's right. You
that's a
got it.
joke.
You
Yeah,
got
yeah.
it. So
But if you want to pull your slide deck back up,
yes, where did we get cut off here? Let's see. Let's pull that up. I finished the whole presentation, you guys, and it was really good. So I'm sure it will,
awesome.
there we go. Let's see here. So I was talking about how we can, as a sponsor, did you guys hear this part about how,
Go back one more.
okay, wow, I was back, went back a long ways. Okay.
I know we made it through
We're
this part.
seeing this one, yeah.
Yeah.
Okay.
I think
Excellent.
you were right in the middle. You had finished this part as well. So I think we're on the next
Okay.
slide.
Okay, excellent. No, this was where I started. I've mentioned a lot of the times I sit in these webinars and I get a ton of information. And what do you do with it? If you're a sponsor, go run with this information. Take a look at the way that you have things structured. Make sure that you're doing all the things that you can to properly tax affect your syndications. As a CPA, I can help sponsors attract capital through self-directed IRAs and make sure that you have it properly structured to really reduce your UBIT exposure. I can help you work through setting up the Class B or the debt-free options that we talked about today, help with your investor-facing language and kind of help you make your offerings more self-directed IRA instead of 401k friendly. So, and then most importantly, I can set you up with some vetted cost segregation people that will make this whole thing work for you and help really eliminate the UBIT exposure in your syndications. So I have my email address below here. If you're interested in learning more, feel free to just email me. I'm putting together some just very compelling packages just to be able to help people kind of take their deals to the next level. But if you are an investor, one of the things that I do a lot is help you strategically allocate your capital. A lot of investors have cash that's sitting in old 401ks, it's sitting in old IRAs that you want to get self-directed. And it's a lot easier than you may think. I mean, you literally make a phone call to Matt and Carl, and they will walk you through the entire process. The hardest part is actually to get your old company to let go of the money and send it to them. Once that happens, it's pretty easy. Wouldn't you guys say? And then what I'm able to do is help walk you through your options. You have money in your self-directed IRA. You have cash. Where does it make the most sense from a tax perspective to invest things? You know, for example, I mentioned the vacation rentals. As a short-term rental owner, there's a ton of really cool tax advantages that you can have to even offset your W-2 income, but you can't do it in your self-directed IRA. I can show you how to do that. And then in your self-directed IRA, you can literally have this money, you have 30% of your money buying you 100% of these assets that are going to grow and double your money in 5 years, essentially close to tax-free. And then, especially if you're in the Roth that Carl's talking about, you take the money out tax-free as well. So there are some really cool different strategies just depending on what you have, what your goals are, that I could help you walk you through what really makes sense for you. And then one thing that a lot of people have asked me about, and it's totally unrelated, but if you do have appreciated rental properties, one of the things that's really important to know about are 1031 exchanges. And I know early in my career, I thought, oh, that sounds really scary. But if you understand the process, it's really super easy. You can take a property that you bought, I don't know, 10, 20 years ago, that's a rental property, and it's now $1 million. You bought it for $100,000. You literally have $900,000 of unleashed, locked up capital, essentially. You could sell your $1 million property and be able to invest it in syndications, for example, that are going to be passive and grow tax, these tax strategized ways, and provide you income that you normally would not be, because you're just sitting on it within this property. So that's also a really cool strategy I'd love to talk about. And then also, as a self-employed person, let's find ways that you can be maximizing the amount of solo 401k money that you are able to generate from your entities each year. It's $75,000 if you're over 50 years old, so close to 75,000. Is that right, guys?
Yep.
That you can invest, and then you put that into your solo 401k, and then you invest into these real estate strategies. So you are basically, compounding your tax savings, because you're saving money from your ordinary income, and then you're growing that money either tax-free if it's a Roth, or tax-deferred if it's not. So lots of really cool ways to really kind of help you keep more of the money that you earn. That's kind of what my whole story is all about. Here's my contact information. Feel free to reach out to me. I love talking about this stuff, as you can tell. Connect with me on LinkedIn. I try to publish information or different stories about different types of real estate tax things that hopefully are interesting. I try to make it fun. So great talking with you guys, and I'm open for any other questions you have.
Thanks, Michelle. I really appreciated it. I do want to emphasize a couple of things. One is, you were 100% right. If you're thinking about, if UBIT is going to apply from an investor side, look for the 401ks from the unrelated debt financed income, because that's an easy way and saves the time and energy of doing the 990Ts in most cases. And secondly, if you do have UBIT, you can figure that out based on the projections ahead of time. So always look at your options, where are you going to end up with the most money? And Michelle can probably help you do that as well, based on the projections of the syndication or asset that you're going to invest in. So you'll know if everything goes according to plan, how much your UBIT or UDFI will be in the future.
There was another question that came in, and this person said, are you saying a sponsor can have an extra entity? And this is about debt funds. Are you saying a sponsor can have an extra entity that pays straight interest to investors and thus avoid UBIT?
Yes, there's many people there's many equity builders that do that right now. And they write it up, and they have their SEC or whoever writes the original equity private placement. They write this one up, and basically it says this debt fund is going to lend to this equity fund, and the people are going to be paid at whatever rate they are annually, quarterly, etc. So it's all lined out and spelled out in there. And it's just,
And the way that I understand it as well is that they can still borrow money from a bank and still have it leveraged, and then effectively reduce their cost of capital, because they would have a part of that fund that they would be paying an interest rate to the debt people versus just a return on the equity side. Is that correct?
Sure.
But they can still leverage it and get a lot of those benefits as well.
right. And it may have to be in second position.
Mm-hmm. Yeah,
something.
most likely,
Because
yes.
the bank isn't gonna want it in first, so they have to understand that. But there's other capital raises where it isn't just real estate, but it's other funds where they can just use that debt fund and not be owning the equity.
Exactly. Well, and that's why they're paying 8 to 10% interest versus the bank that's getting, 5, 6, 7%. So they're getting paid for that risk by
Oh, yeah,
using a business
the
structure.
banks now are like 8, 9%, and people are making 10 to 12%, but it's still way better than the equity multiples that supposedly the people are coming out, as you said earlier, the 20% by the time,
Mhm.
right?
But if people are 59 and a half and want the cash flow, 8 to 10% cash flow a month or a quarter is pretty nice as well. So it's
Sure.
kind of some benefits to doing it all. And as an investor, you don't have to just invest in, just with your cash. You can invest in your self-directed IRA, in your cash, and in the debt fund and the equity. There's a lot of ways that you can spread your allocations between these as well. So it gives you a lot of options.
Yeah, a few years ago, people were using equity lines like crazy, right? Borrowing money at 2% and then lending it out at 8 or 10. Now the equity lines are 9% plus or minus 1. So
Absolutely.
not as easy to do.
Well, this was fun today, guys. I hope everybody here has learned some stuff about UBIT and made it somewhat fun. Maybe not too boring, not as scary as it may have been.
It wasn't scary.
Good,
The
good.
hair is not standing up on my arm, so we're
That's a
okay.
good thing. That is a
Yeah.
good thing.
Awesome. Well, thanks very much for being here, Michelle. We really, really appreciate you spending the time to prepare this presentation and to share it with us. It's, like I said, it's a topic that comes up very often with me on my calls day to day, and also with folks on the sales team at CamaPlan. So I hope everyone is collectively smarter about UBIT. It's not scary, like you said, and we can go take on the world with all this knowledge.
Absolutely. Go make lots of money.
Exactly. All right.
Tax free.
And,
Okay, great.
and congratulations to the person that picked up on the debt fund and there, because it is a great idea.
Awesome. Cool. Well, you
Thank
see
you, guys.
Michelle's contact information there, and my contact information was shared in the chat. So if you're interested in working with CamaPlan to help you fundraise from your IRA, from your investors' IRA accounts, or you just want to open up an IRA account, please reach out to me. And then also, if you have any questions for Michelle, don't hesitate to reach out to her. So
And is this being recorded, Matt, so people can go back and listen to it?
absolutely. Yep.
Show it to their advisors? Thanks.
Yep. Cool. Well, thanks again, Michelle and Carl. Thank
Absolutely.
you for your leadership, and we'll see everyone on the next one.
Okay, great. Thanks,
Bye.
guys.